How are you specifically positioning yourself for the start of 2018?
Okay.
What are you excited about? What are you concerned about? You mentioned mortgages a while ago.
Yeah. So we've been in mortgages for the most part for many years. It's our two largest positions in the portfolio are closed-end funds that are primarily non-agency MBS, which are non-agency mortgage-backed securities. The non-agency part's the key. That means it's not available to be purchased by Fannie or Freddie Mac, the two large government-sponsored entities that create the secondary market for mortgages. The non-agencies are kind of a byproduct of the old housing boom from 2000 to 2007. You can think of Countrywide or Washington Mutual or those third-party originators. Those loans are still out there, and there's a lot of securities you can buy to take advantage of those because they were selling at 20-30 cents on the dollar at some points back in 2010 and 12, and now we're getting up to 90 cents.
Wow!
But even at that 90 cents and a strong, let's call it 5.5-6% yield, you still get a total return, mid sixes to high sixes, which in this market, especially for the risk, is very attractive.
Yeah, no doubt.
So in terms of positioning for 2018, we still like that space. We're still in it because I think, to get a 6 and 6.5% yield plus for what we think is BBB rated securities, if they were to be rated today, again, these are all not rated anymore. If you remember the movie The Big Short, they were all rated AAA by the NROs, by the rating agencies, even though they were not AAA. And then following the recession, following all the foreclosures, they all went to not being rated. So, and when they're not rated, they're typically thrown in with junk bonds. So we think we can get junk bond yields for investment grade risk.
Nice.
So that's why we've been significantly overweight them for the last let's call it 2 years since we started the service, and we're still overweight them today. But we also like REITs here. We think REITs have been very kind of left for the wayside, especially in the last year. The VNQ, which is the Vanguard REIT Index, is only up about 5.5% this year, obviously compared to the S&P, which is up over 20. So a 1,500 basis point variance there. And we think that's largely due to the lack of tax reform and the fear of higher rates. And both, I think, and when I say lack of tax reform benefiting REITs.
Right.
So there was not very much in the way of any benefit to REITs. In fact, it was probably a negative to REITs because corporate rates coming down means the relative tax efficiency or tax attractiveness of a REIT goes down as well. So we think REITs are positioned well here. So going into 2018, again, we're going to be a little bit more defensive, meaning we're looking at higher quality. So we have some investment grade closed-end funds as well as those mortgage closed-end funds. We do still have some high yield. High yield does have some left to it, some upside left to it. It's not the overwhelming kind of buy flag that it was last year. But, we think it can earn its coupon plus maybe 1%, so give us maybe 7 there. And then, again, we're going to be overweight REITs pretty significantly here. And we like to barbell our REITs. So we'll go with high-quality REITs like Simon Property Group, which is a mall REIT, which owns the top malls in the country. It was beaten down pretty strongly along with all kind of retail-focused names, including the REITs. So we'll own high-quality things like that. National Storage is another one that we've owned, which is a self-storage REIT. But we'll have those, what we call those 3 to 5% dividend payers, which are those high-quality REITs, and we'll pair it with the speculative REITs. One that we like in that space is called Colony Northstar, and another is Sabra Healthcare, which is a healthcare REIT. Both those are in double digits for yields. Sabra is a great name that kind of fills the bill to that strategy I discussed earlier of buying stocks that are just below that investment grade and where they're deleveraging the balance sheet, they're improving the balance sheet, and we think they'll get to an investment grade rating and the stock will take off.
Interesting.
But in the meantime, we're getting paid a low double digit yield to wait, and we can't. That's to us, that's fantastic, and the dividend's well covered. We don't see any sign that they'll have to cut the dividend, and so to us, that's a win-win, right? We're getting paid 12% or so, and in the meantime, until the shares take off, which we think they will sometime next year.
And by take off, is that we're talking like 10, 20% over a year, or way more than that?
Usually, I would say, our target there is about 20%.
Okay, that's great for a year.
In the micro, yeah, right. I mean, so we're not looking at microcap stocks that we expect to go up 100%.
Sure.
Our main strategy is to hit singles and doubles. I mean, it's a corny saying. It's overused, but it really kind of fits the bill for what we try to accomplish. We don't want to give out 10 recommendations on 10 different stocks in the hopes that 2 of them go up 100%. Really, we would like to see, and actually, our core portfolio, which is primarily bond funds, but does have some REITs in it. Every single one of our positions last year was up. Now, it was a great market,
sure,
but still, you're always going to have losers in any pool, and especially since we have 16 names in there, and to have all of them up, there was obviously rotation through there, turnover, but we were pretty happy with the result.
Yeah, you should be. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.